6,978. That is the flashing number on the board for the S&P 500 futures right now. We are oscillating, dead flat at the line, really struggling to reclaim that psychological 7,000 handle. The sentiment reading is neutral, but if you look under the hood, we are seeing a massive volatility crush, or what looks like volatility suppression. The market is pinned. Welcome to the deep dive. Today, we are breaking down the overnight Fed catalyst, the violent split in big tech, and why the bond market might be screaming a warning.
It's great to be here. And pinned is exactly the right word. It's the definition of a standoff. You look at the tape this morning and it's just coiled. Big money is parked. We're seeing a complete pause in conviction as the market tries to digest two very different stories.
It's divergence.
A massive divergence in mega cap earnings and what I can only describe as a hawkish hold from the Federal Reserve yesterday.
Let's start right there with the macro picture. The overnight catalyst. The Fed kept rates steady at 3.75%. I think most people expected that number. But the reaction wasn't about the number itself, was it? It was about the tone.
Exactly. The 3.75% hold, that was priced in. What wasn't priced in was Chair Powell just absolutely refusing to commit to a first-half rate cut. It feels like that refusal has poured cold water on the entire bull trade.
So he's pushing back.
Hard. He basically told the market, don't get comfortable. By not committing to an H1 cut, that's the first half of the year, he's forcing investors to pivot from a liquidity-fueled rally to an earnings reality check.
Yeah.
And that is dangerous when you've got the S&P teetering right here.
And just to set the table, the macro focus shifts immediately to the data drop at 8:30 a.m. ET, Initial Jobless Claims. Why is this number the one we need to watch right now?
Because the Fed is data dependent, right? This is the critical piece. The market needs to see if labor is cooling fast enough to force the Fed's hand by June. If that number comes in hot, and a hot labor number means low claims.
A strong labor market.
Right. It validates Powell's hawkishness.
Yeah.
If the economy's too strong, he keeps rates high. And if that happens, that 7,000 handle on the S&P becomes a concrete ceiling, not a floor.
Okay, so we have the macro ceiling. Now let's get to the micro movers, because that divergence you mentioned is showing up violently in the pre-market. We've got a serious split in the magnificent names. Let's start with Microsoft. Ticker MSFT. It's gapping down 6.1%. That is a huge move for a company that size. What's going on?
This is the spend now, profit later narrative finally hitting a wall. Investors are punishing the capex spend.
Let's pause there. Capex, capital expenditures. We're talking about the money they're pouring into data centers, buying chips.
Billions of dollars. Microsoft's capex just soared past expectations. Now, usually, spend is fine if you show growth, but we didn't get that. That commensurate revenue beat in Azure to justify it.
Azure, their cloud computing arm.
Right. So the market is asking a very simple question. Where's the ROI? Where is the return on investment? It's a classic case of AI fatigue, not on the tech, but on the balance sheet. They're building the factory, but the orders aren't filling it up fast enough.
Contrast that with Meta, ticker Meta, gapping up 7.0%. They're spending on AI too, aren't they? Why is the market treating Zuckerberg like a hero and Nadella like a villain this morning?
Because Zuckerberg found the Goldilocks zone. He showed surging ad revenue, which is the monetization piece everyone wants to see, and he did it while keeping his capex stable relative to that growth. It's the flight to quality play within the AI sector right now.
So investors are saying, you're spending, but you're also printing cash now.
Exactly. That's the safety trade. Microsoft promised future profits. Meta delivered current cash flow.
Fascinating. And then there's the wild card, Tesla. TSLA up 1.9%.
This one is, well, it's interesting because the fundamentals are actually messy. Profitability is under pressure, margins are compressing, but the stock is up. Why? The robo-taxi narrative is holding the floor. Retail is betting on that 2026 autonomy timeline. It's a hope trade.
So that brings us to the hook for the entire day. The stakes are huge for this afternoon because Apple reports after the bell.
It's the binary event, the coin flip. With the S&P struggling here at 6,978, Tim Cook's guidance on the iPhone 17 is going to decide the direction of the whole market. If Apple misses, or even just guides soft, this tech split we're seeing could become a broad market retreat.
Okay, so that's the setup. Let's unpack the market posture. You said the tape is coiled. What does that mean for execution right at the bell?
It means we're in what's called a liquidity trap, this tight oscillating range. It's designed to stop out retail hunters on both sides of the VWAP.
VWAP, volume weighted average price, the institutional benchmark.
Exactly. When the market is coiled around that line, it's dangerous. If you're placing market orders at the open, you are effectively providing liquidity for institutions to exit. You're the meal.
So the advice is Avoid market orders in the first 30 minutes.
Absolutely. Sit on your hands. The first half hour will be a stop run. The algos will push price up to grab the short stops, then flush it down to grab the longs. It's a washing machine. You have to wait for the dust to settle.
Let's put some hard numbers on this. Looking at the S&P 500 futures, the ES, where's the line in the sand?
For ES, the pivot is 5,985. We're trading just below that 7,000 level on the index, but on the futures, 5,985 is the control rod. Above it, bulls can make a case. Below it, we are hunting for sell-side liquidity.
And the ceiling, if we do get a pop.
Resistance is stacked at 6,022. That's the 3-day high. A lot of institutional selling pressure is sitting right there. If we rally into 6,022 and stall, that is a textbook short entry. You bet on the failure.
And if the floor gives out,
support is 5,960. But here's the danger. If 5,960 phase, there's not much structure below it. It's an air pocket. It triggers a trapdoor move down to 5,925, and it could happen quickly.
so the strategy on the ES is a neutral bias as long as we're chopping between, say, 5,970 and 6,010.
Exactly. Scalp the edges. Don't marry the trend in the middle.
Okay, let's look at the Nasdaq 100, the NQ. This looks weaker.
Much weaker. Tech is showing relative weakness because of that rotation. The NQ is just hugging its high-volume anchor at 21,150.
That's the line in the sand, 21,150.
That is the pivot. We are right on it. If we can't hold this, the resistance is 21,340. But here's the catch. You need confirmation. We need 2 consecutive 15-minute candles closing above it to confirm a breakout. Otherwise, every pop in the Nasdaq is a sell-the-rip candidate.
And the floor on the NQ.
20,980. That's the psychological support. If we break 20,980, you're going to see forced liquidations.
Forced liquidations. Sounds painful.
It is. These are over-leveraged longs getting margin called. Their brokers automatically sell, which drives the price down further. It's a cascade.
You called the NQ the canary in the coal mine.
It is. If the NQ loses 21,000, the S&P futures will follow it down. Doesn't matter what breadth looks like in staples. If tech goes, the market goes.
Okay, let's zoom out. We have the technicals, but we need the macro overlay. Because while stock traders are watching charts, the bond market is screaming.
It is. And the bond market is usually the smart money. Right now, it's flashing red. The 10-year yield is at 4.27%, rising off a technical head and shoulders bottom.
And the DXY, the dollar index, is stabilizing.
Bouncing off 4-year lows, yeah. But the yield is the main story. At 4.27%, the risk-free rate is eating the equity risk premium alive.
I'm going to stop and really explain that. Equity risk premium. Why does 4.27% on a bond matter so much?
Think about it this way. You have 2 choices. Lend your money to the U.S. government for 10 years, get a guaranteed 4.27% return, 0 risk. Or you buy stocks, which are risky. So to take that risk, you demand a premium extra return on top of the safe rate.
Makes sense. I need to get paid for this stress.
Exactly. But right now, because stock prices are so high and yields are rising, the gap between the S&P earnings yield and the 10-year yield is turning negative.
So I am paying a premium to own risky assets over a guaranteed bond. That seems backwards.
It is backwards. It's the definition of a valuation trap.
Yeah.
You're taking on all this equity risk and getting paid less for it than just parking cash in a treasury.
And this is creating what you call the bond market protest.
Right. Investors are selling treasuries, hedging against inflation and deficits. That selling drives yields up. And here's the pain trade. As yields approach 4.5%, the policy pain threshold institutional capital has to rotate. If a pension fund can get a guaranteed 4.5% in paper, they will sell their Microsoft to get it. They care about the math.
So we could see a meltdown in multiples, even if the companies are performing okay.
Precisely. Retail is waiting for a melt-up in prices, but the smart money is positioning for a meltdown in valuations. The key level is 4.30% on the 10-year. If we break that, the floor drops out of this tech rally.
Which sets the stage for sector rotation. Despite the vibe in Microsoft, you're still saying technology is the dominant liquidity magnet.
It's where the volume is. You can't ignore it. But you have to be selective. The rotation is happening within the sector, out of pure hardware into software and services showing margin expansion.
Proven by Meta this morning.
Proven by Meta. The market wants to see the cash register ringing, not the construction crews building.
Let's get specific on the tickers. You had to start with the big one tonight, Apple. AAPL.
The prove it trade. AAPL is down 6% year to date. It's been dead money. The fear is all about China.
So give us the levels. What are we watching?
The bull case. A break above $242. If they beat on services revenue and give upbeat guidance on the iPhone 17, we break $242 and target $250.
And the bear case. If China is weak,
If they lose $218.50, that's the danger zone. If we hear anything negative about China margins and the stock drops below $218.50, it likely flushes down to the 200-day moving average. That would be ugly.
next back to Microsoft. MSFT. Is this a recovery trade? Or are we catching a falling knife?
It's a recovery trade setup. You have to be patient. Wait for the level. The bull case requires reclaiming $455. If it gets back above that, it signals the market believes the Azure slowdown is just a capacity bottleneck.
Which is a good problem to have, theoretically.
It is, eventually. But if the stock fails to hold $430...
That's the bear level.
Right. If MSFT fails at 430, it opens the door to retesting the Q4 lows. That implies the market thinks the problem is management, not demand.
Third ticker, MasterCard. MA. Reporting pre-market. Why is this on the radar? It's not a tech play.
No, but it's the truth serum. It tells us about the real economy. Are you and I spending money? It validates or kills the soft landing narrative.
What are you looking for?
Bull case. Price over $545, driven by strong cross-border travel. It means the global consumer is healthy.
And the bear case.
Below $505. If they mention rising delinquencies or a tapering of middle-class spend, that kills the soft landing story instantly.
All right, let's wrap this with a playbook. Summarize the strategy.
2 setups for day traders. On the S&P futures, ES, look for a look above and fail at 6,022. If price spikes to 6,022 and immediately rejects, you take the short.
And on the Nasdaq.
A wash and recover at 20,980. If it flushes down to that level and then quickly reclaims it, that's your long scalp. You're buying the fear.
Risk management.
Crucial. Hard stops. 15 points behind your entries. Volatility is suppressed, which is dangerous. When the move happens, it will be fast. Do not trade without a hard stop.
Before we go, we have to mention the smart money hedge. Another asset screaming in the background.
Gold. $5,500.
Breaking records.
It is. And that should tell you something. Stocks are neutral, yields are up, and usually when yields are up, gold is down. But right now, gold is ripping to $5,500.
What does that tell you?
It suggests institutions are hedging against serious fiscal uncertainty. They're buying insurance while retail's buying lottery tickets. It's a flashing yellow light on the dashboard.
A sobering thought. Watch the yields. Watch 21,000 on the Nasdaq. Trade the levels, not the headlines. The bell is ringing.
Good luck out there.